All right, if you're in crypto, I bet you spend your time watching the Bitcoin chart, maybe you're deep into on-chain data, or you're following the latest project updates. But what if the single most important person for your portfolio isn't even in crypto? Today, we're going to unpack exactly that, how the US Federal Reserve is actually the one pulling the strings.
And look, that is not an exaggeration. This is the big idea we're diving into. When the Fed chair, right now that's Jerome Powell, when he even whispers, the entire global market holds its breath, and that absolutely includes crypto. So you can forget about the whales for a minute. The Fed is the entire ocean.
So, you've got to be asking, why does this one US institution have so much power over a global decentralized asset like Bitcoin? Well, it's actually pretty simple. Almost everything, stocks, gold, oil, and yes, Bitcoin, is priced in US dollars, and the Fed controls the dollar. So if you control the yardstick, you control everything being measured.
Yeah, just think about it like this. The Fed is basically setting the rules for the world's money. When they make a change, it's not just a small ripple in a pond. No way. It's a tidal wave that crashes into every financial market on the planet. And that includes the digital shores of crypto.
Okay, so how do they do it? How does the Fed actually control things? Well, it really comes down to two main levers they can pull to either hit the gas or pump the brakes on the economy. Let's break them down.
All of the Fed's immense power really just boils down to these two things: the cost of money and the quantity of money. First, they set interest rates. That's the cost of borrowing money. And second, they control the money supply, which is the sheer quantity of dollars out there. Cost and quantity. That's it. That's the whole game.
So let's just trace the cause and effect here. The Fed cuts rates. Suddenly, borrowing money is cheap. At the same time, your savings account and those safe government bonds are paying you practically nothing. So, what do? What does every investor do? You go searching for better returns, right? And that search pushes everyone into riskier things like tech stocks and, you guessed it, Bitcoin.
Now that other lever, it's just as powerful. It's called quantitative easing, or QE. It's a fancy term, but all it really means is the Fed is printing new money to buy bonds. This just floods the whole system with cash, with liquidity. And it's basic economics from there. You have way more dollars chasing the same amount of stuff, so the dollar price of that stuff just has to go up. So, you take these two levers, interest rates and the money supply, and put them together, and they create this massive phenomenon that every single investor, especially in crypto, absolutely has to understand. It's called the liquidity wave, or the liquidity cycle. And this, my friends, is where it all clicks into place.
This concept is everything. Just think of liquidity as the fuel for the entire financial engine. Central banks, with the Fed in the driver's seat, control the flow of that fuel. And by doing that, they create these huge, predictable cycles of boom and bust. And really, the cycle is pretty simple. It's got two phases. You've got expansion, where money is cheap and easy to find. That's a risk-on party, and assets like crypto absolutely fly. Then you get contraction. The Fed starts pulling money out of the system, that's called quantitative tightening, or QT, and money gets expensive. Risk assets, they tend to get crushed. And this right here is why Bitcoin is so volatile. We call it a high beta asset, which just means it's super sensitive to these liquidity cycles. When that tide of money comes rolling in, Bitcoin rockets up higher and faster than almost anything else. But when that tide goes back out, well, it falls just as hard and just as fast.
Now, the good news here is that the Fed isn't some super secret organization. They actually tell us what they're thinking and what they're planning to do. The key is just learning to speak their language and knowing where to listen.
So when you hear on the news that the Fed is sounding hawkish, I want you to picture a hawk, right? It's circling, it's ready to attack inflation. That means they're getting ready to raise interest rates and make money more expensive. For crypto, that is a major, major headwind. And the opposite of that is dovish. Think of a peaceful dove. This means the Fed is more worried about jobs and stimulating the economy, so they're thinking about lower rates and easier money. For risk assets, this is the ultimate green light.
So where do you find these signals? Well, you have to watch the FOMC meetings. They happen 8 times a year. Pay close attention to the press conference that happens right after. And here's a pro tip. Look for something called the dot plot. It's literally a chart they release that shows where all the Fed officials think rates are headed in the future. It's like they're giving you a sneak peek at their playbook.
Okay, that was a lot of theory. I get it. But now for the fun part. Let's talk about how to turn all this knowledge into an actual playbook you can use for your own crypto strategy.
Because at the end of the day, that's the only question that really matters, isn't it? How do we take this big picture macro stuff and use it to make smarter decisions with our own money?
Here are the big mental frameworks you need. Number 1, and this is the most important, follow the liquidity. Don't fight the tide. Be bold when money is flowing and be cautious when it's drying up. That also means knowing if the Fed is raising rates or cutting them and keeping an eye on the US dollar. These things tell you whether you have a nice tailwind pushing you forward or a nasty headwind holding you back.
So, practically speaking, what do? First, get a calendar and mark down all the FOMC dates. Be super careful with leverage around those days, because you know things are going to get volatile. And remember, do not fight the Fed. And keep your eyes peeled for any sign that they're about to pivot or completely change direction. That's usually where the really big moves happen.
Look, I know this can sound a little abstract, so let's just look at the last few years, because it shows this whole theory playing out perfectly, right in front of our eyes.
I mean, just look at this timeline. It's incredible. March 2020, the Fed turns on the money printer and bam, Bitcoin bottoms and starts that insane run. All of 2021, the party is raging. Then, November 2021, the Fed even hints that the party's over, and Bitcoin peaks, almost to the day. Then comes 2022, the brutal bear market, driven by the fastest rate hikes we've seen in decades. The pattern? It's just so clear.
Now, is it a perfect one-to-one correlation every single day? Of course not. But Fed policy is what sets the entire backdrop. It creates the environment. It tells you if you've got a tailwind at your back or if you're sailing straight into a hurricane.
And really, that's the best way to think about it. Macro isn't a crystal ball. It doesn't predict the future. But it is the weather forecast for the markets. And you wouldn't head out on your boat if they were forecasting a Category 5 storm, right? So don't fight the Fed's forecast. It's your single biggest strategic advantage.
Now, the Fed is definitely the biggest storm system out there, but it's not the only one. Next time, we're going to zoom out even further and look at global liquidity. We'll explore how the central banks in China, Japan, and Europe all add their own currents to this massive ocean of money that moves everything. Hope to see you then.